If you're looking for a way to generate passive income, dividend investing might be the right strategy for you. In today's video, we're going to examine dividend investing, and we're going to look at the dividend stocks that I have in my portfolio and see what I've done with them. So let's get started on our path to financial freedom. As always, before we do that, we're going to examine my portfolio. We're going to look at the metrics and see how it's performing. We're going to buy some stocks, and we're going to see the dividends that we've earned since the last video that I posted. My name's Darren, and this is the Crazy Canuck Investor, where I try to make investing a little bit easier for beginners, because let's face it, there's nothing that gets you ready for that first day of your investing journey. And I do it by sharing my journey with all the ups and downs along the way. All right, folks, this week's movie recommendation is a blast from the past. It is an action thriller that brings you much comedic relief. That's right, Eddie Murphy is back in the fourth installment of the Beverly Hills Cop series. This movie is all about time and age. But even despite that, the characters are still as good as they were 30 years ago. This movie made my wife and I sit on the edge of our seat, but laugh through the whole thing. And I think you'll probably get the same enjoyment out of it. For those of you that like to hold single stock positions, anybody that owns NVIDIA will think that they've won the jackpot in Las Vegas. NVIDIA's growth since 2022 has been absolutely outstanding. The growth charts look something like climbing Mount Everest. Particularly of late, it has been the talk of the town, so much so that it has become one of the top 7 companies in the S&P 500. Now, after my recent video where I introduced it by saying, knowing what I know now, one of my viewers said, knowing what you know now, if you had owned NVIDIA, you would be well ahead of the game. And while that's true, I don't really see it that way from a beginner's perspective. Now, let's face it, as a new investor, investing in single stock positions is something like gambling. Now, this is my viewpoint, and I'm not reflecting everybody else's view, but at the end of the day, you would need to understand this company inside and out, and even when you do that, there's absolutely no way to predict the growth of a company like this. So that's why I've chosen of late to stick more to ETFs. All right, so the entire portfolio is up to $142,847, comprised of 4 separate accounts. The first we're going to start with is my cash account. Now, this account is effectively our main bank account. We are transitioning from the big bank over to Wealthsimple. I did a video on that, and you can check that out right here to find out what the reasons were. Now, this cash account pays 5% interest. Why do I show you this account? Because it's important to have an emergency fund set aside in the event that you were to lose your job or perhaps have a paycheck that didn't work out. There's no point in investing if you don't have an emergency fund set up. So what we do is we put our money in here and we earn interest. You can see here that we've earned $8.08, and that's 5% interest. Of course, that is taxable interest. So the way we take care of that is I take that money and then I throw it into our spousal account. I have one set up for my wife. I get the tax credit. So here we have, in June, we earned $127.58. Of course, I took that money and then invested it into the spousal account so that my wife can then take that out later on. And here is a spreadsheet that I keep that's tracked since we opened it in August of 2023. And you can see each month how much money we've earned. And then, of course, it totals it up. So as of just after June, we have $1,215 in interest that we've earned. And again, that money has been invested and is earning interest in the investment side. Now let's jump over into the kids' RESP, Registered Education Savings Plan. We have 2 kids. That accounts $65,448. And one of the features I love about this robo account, yes, I pay a fee for it, is they show you what equities you're invested in through asset allocation, which is a fantastic metric for me to look at and see what's going on. Here's an example. So on the US side, we have 29.3%. That's 19,000. And it is earned performance-wise, all-time, 27% increase. Fantastic performance. All right, when we scroll down, we're going to look at a few of the other ones. We have gold. That's right, invested in some gold. Not very much. It's $1,700, but look, Gold's performing great right now, up 25%. Looking, and we do have some government bonds. They are the sluggish of the portfolio at negative 1.6%. Really not that terrible of a loss, I suppose you might say. All right, so looking over at one of the other metrics, we can see the all-time performance. We have $55,000 invested, and over the last year, we've earned $8,000 growth in this account, which equates to 15% total growth investment. Again, it's the best performing I have in all of my accounts, but the other ones are starting to perform a lot better. In the activity tracker down below, since the last video, we can see what's gone on. That was on June the 25th. So as of the 25th, we invested $100 for each kid. We invested, then it was invested into EEMV, GLOV, ZEA, and QCN. If you want to know what those are, I would highly suggest looking them up. They're ETFs that really anybody could invest in. And then we had a dividend of $50 from GLOV, and we got charged a non-resident tax that you saw there. All right, jumping over into my RRSP. The performance, the 1 day, it's up $4.60. Over the last week, it is up $46.93. And over the last month, it's up $64. And of course, over the last 3 months, it is up $423. Over the last year, it's up $1,929, which is 12%. And all-time returns on this account, $1,925, which again is 12%. I'm super stoked about that. There's only $6.40 in here to invest. You can see 1728 is not available. That's because DRIP is turned on. I don't have to do anything. Dividend comes in, automatically reinvested back into that security. Back to the last video, AVUV paid out $5.57, AVDV paid out $13.38, and XEI paid out $11.36, all of which was reinvested back into those securities. CNR paid out $5.92, and you can see there the two pending transactions when I recorded this that are set to go back into each of those securities. All right, now let's jump over into the TFSA, the focus point of the channel. Up to $30,497. The one-day return is down 0.73. That's really nothing. Over the last week, it's up $67, which is about 0.22%. Over the last month, it's up $239. Over the last 3 months, it's up $516. Over the last year, it's up $2,848. And all-time returns on this account up $2,915. Absolutely fantastic. Only 23 cents there to invest. $127 of that is set on DRIP, so it's being reinvested. We'll see it in the activity tracker. All right, so BAM paid out $13.59, XIC $13.03, XIC $3.99, XEF, a new one that I introduced not long ago, $70.71. XEI paid out $10.31, XEC $13.31, and XEC again $2.70. When you see manufactured dividend, that's because it's on loan. So they manufacturally put in a dividend for me, and then you have to add in the other part together for the full dividend. And all of that in those pending transactions there are being reinvested back into each one of those securities. All right, so we do have stock lending turned on. We've only earned 59 cents. This part of the program will show us what it's invested in and what's been loaned out, and that's updated on a daily basis. Again, only earned 59 cents. Next payday, July the 15th. So that money will continue to grow. I'm going to keep it turned on. I don't really have to do much with it in order to see the returns that I'm getting. And again, they're super small, but every little bit helps. Investing is about making smart decisions with your money as opposed to throwing your money away, really. Now we're going to put some money into the account to do the investing, and that's $1,000 every 2 weeks when I get paid. So I just got paid, so we're going to fire that money in there. And then we're going to use passive. Passive is a great tool for your asset allocation. If you don't know what asset allocation is, I did a video on it, check it out, and you'll figure that stuff out for yourself. All right, so we're 90% accurate. We have $1,000.23 to invest. Total invested right now is $31,915. And of course, what we're going to do is have Passive help us with that $1,000 to tell us what we should buy to keep up with our asset allocation. We're going to buy 7 shares of Plaza REIT, 2 shares of QQC, 1 share of REI, 2 shares of VFV, that's the S&P 500, 2 shares of VRE, 5 shares of XEC, 6 shares of XEF, 4 shares of XEI, 3 shares of XIC. Again, this is all to conform with that asset allocation that I've set up. Now, it is simply a guide. It doesn't mean I necessarily have to follow it. I could have taken that entire $1,000 and invested it in one security, but that's not what I'm doing right now. I'm following this asset allocation to keep building on the successes that I've had so far. All right, today we're delving into the world of dividend investing, a strategy that can provide you with a steady stream of passive income. So what exactly is dividend investing? It's a strategy where you invest in companies that regularly distribute a portion of their earnings to the shareholders in the form of distributions. Examples of this would be Enbridge, Canadian Natural Resources, and Alaman Couche-Tard. Now, this is not an exhaustive list, and I would highly suggest that if you're going to invest in these companies that you take the time to research them yourself, so make sure you do your own research. First, let's examine why dividend investing can be a benefit to you as an investor. The most obvious thing is the opportunity for passive income. Unlike growth stocks, which take their income and reinvest it back in the company to make it grow, dividend stocks take their income and pay a portion of that back to you, mostly on a quarterly basis. Attractive dividend stocks can be ranked as dividend aristocrats. What makes a company a dividend aristocrat? It increases the dividend it pays to shareholders for at least the last 25 years, and it must be a part of the S&P 500. Now, these companies tend to be large, they are somewhat recession-proof and enjoy steady profits and growing dividends in good times and bad. Examples of companies such as Johnson & Johnson, Coke, and Exxon, which is held by the world-famous investor Warren Buffett. But, of course, there is more. Some companies are actually ranked as dividend kings. Dividend kings are firms increasing their dividend annually for more than 50 years. Imagine receiving a paycheck every 3 months for simply owning a stock. This can be particularly attractive for retirees or anyone looking to supplement their income. But not all dividend stocks are created equal. It is important to look for the companies with a strong history of paying and increasing their dividends. This shows financial stability and commitment to the return for the value for shareholders. Okay, so now let's examine my portfolio and we'll take a look at the dividend stocks that I have in my portfolio and what I've done with them. Now, something to keep in mind is that this is simply highlighting my TFSA and my RRSP, because remember, this channel was started to show me bringing my TFSA from 0 to maxing this account out. Now, I did recently start a video series that highlights all of the portfolio that I have. And if you want to check that out, you got to jump into my playlist and start checking out all the rest of the other dividend stocks and everything else that goes on in those portfolios. Now, here's a list of the dividend stocks that are in my holdings and what I've done with them. So we're going to start off with Enbridge, Bell Canada, Manulife, TC Energy, Fortis, CNR, TD, and TELUS. Now I'll cover off what I've done with these different dividend stocks. Now let's start with Enbridge. Enbridge is an energy company based in Calgary, Alberta. It presently trades for $48 a share, and its dividend yield is 7.6, which translates to 92 cents a share. Pretty attractive, right? I own this for approximately 1 year, And in that time, the stock price steadily decreased over time. And at the same time, the dividend would continue to grow. Essentially, I'm gaining money on the dividend side and the share price is dropping off. So if I wanted to sell this at some point, I'm actually losing money in the long run. So just because it has a high yield doesn't necessarily mean that it's a good dividend stock to hold. Now, this company has a large debt. And what I found is that they continued to increase their dividend, but didn't take care of any of the debt on the backside. Looking long term, I didn't see this as a good investment because what I'd ideally like to see is that the share price slowly increases as well as the dividend price. So I pulled the ripcord, I sold my entire position off and reinvested that money into the S&P 500 and into some small cap ETFs because I believe that that will grow much faster and I will recoup the cost of whatever I lost from the Enbridge stock. Now let's jump over to Bell Canada because that is the same story. And if you want to check out what I did with Bell Canada and Enbridge, I did individual videos on both of them. And you can see because they were both very similar stories. So check those videos out to see what I did with Bell Canada. Now, Manulife's a different story. Manulife actually grew quite significantly over the period of time that I held it. It grew somewhere in the 15 to 20% range over about a year that I held it. And remember, I've only been investing for just over a year now. Now, some might ask, well, Darren, why didn't you hang on to it? But here's the thing is, it was a very small holding. When I first started investing, if you've watched some of my other videos, you're going to see that I took the shotgun approach. I essentially watched a bunch of videos, didn't really do a lot of research, threw my money in and see what would happen to it. And while Manulife was growing, it was such a small position, as well as I actually own it in other ETFs as well. So I decided to sell off the profits that I had, reduce this one single position, and reinvest again into the S&P 500 and into small cap ETFs. And then I added some international ones as well. So I've removed that. Now, I do have a single position in my kids' TFSA, which is essentially their account for now. And if you want to check that out again, go check out the other video series. You'll see what's going on in that account. All right, so that leaves us with TC Energy, Fortis, CNR, TD, and TELUS that remain in my TFSA and my RRSP. Of those stocks, the ones that I really like are CNR, TD, and TELUS for now. So let's talk about CNR. If you're watching this and you're not from Canada or you're new to Canada, you're going to realize that CN, which is the Canadian National Railroad, as well as CP, are the only two railroads we have in Canada. So therefore, they both have a pretty good moat. There's nobody that's going to come in to build new infrastructure to take over the market share that these companies have. They have, now CNR has a great track record, growth over time, again, a dividend stock. The yield's not incredibly high, but this stock also appreciates over time. Now, right now, it's not performing incredibly well, but neither is our economy. So as the economy is slowing down, people are not buying as much, therefore CNR isn't moving as much merchandise from one side of the country to the other, because that's what they do. But I really like this position and I will continue to add to it over time. Now, TD and TELUS are a bit of a different story. I do like them. Currently, we bank with TD, but if you know, we're switching from the big bank over to Wealthsimple. So TD might not have a long history with me. Time will only tell. TELUS is in the same boat, and both of these stocks are not performing incredibly well, but again, the Canadian economy is not doing well as a whole. So I'm optimistic that those two positions may do better in the long run. And again, I have exposure within the ETFs that I hold. Now, as for TC Energy and Fortis, stand by, because in future videos, you'll probably find out what I'm going to do with these positions. And there you have it, a quick guide to dividend investing. The key is to find reliable companies that reward you for your investment. As always, make sure you take the time to research the companies before you invest in them. Don't take the shotgun approach like I did. Benefit from the videos that I'm putting out to start your investing journey from day one. If you found this video helpful, make sure you give it a thumbs up, drop a comment, but most importantly, hit that subscribe button. It all helps get the message out to other beginner investors that are out there. And if you're just getting started with your investing journey, watch this playlist right here.